Hello, I'm Finola Burke from RaaS Research Group, and joining me is Arnie Selvarajah, co-CEO of Bell Financial Group, ASX ticker BFG. Welcome, Arnie.
Thank you, and thanks for having me.
The Bell Financial Group reported a very strong start to the year with a 37% increase in revenue for the year to date, April 30, and a near 200% increase in group NPAT. How much of this is attributable to an improvement in market conditions, and has Bell Financial Group gained market share?
So two parts to that question. I think we should start by saying that the result is relative to a relatively weak first half that we reported last year. So there is that comp to bring some context. But having said that, we ended the year in 2025 very strongly, and particularly in our corporate finance business, where the markets were running well. And in the particular franchises or sectors that we are focused on, like resources, healthcare, and advanced manufacturing, and specifically in the defense sector, we did very well. And that momentum continued into the first quarter and the first 4 months of this year. Certainly, resources has run well and strong, and even post the war in Iraq, we have been very successful in raising capital for a lot of our corporate clients in the first 4 months of the year. We have gained market share in corporate finance. We were ranked eighth in the 2025 year for the first quarter, according to the LSEG league tables. We're now ranked third. So our share went from 4.4% to double, actually, to 8.8%. So certainly we've outperformed our peers in the first 4 months of the year. On the trading side, in the Bell Potter Securities business, and also the trading components of the Bell Direct and Desktop Broker business, our shares grown slightly, 0.1% growth in share in the first quarter. Small, but we'll take that. But so I think it's two parts to the story. One, relativity to a poor start or a weaker start last year, but also some strong performance across the business and specifically in our corporate finance business.
And you recently unveiled the strategy to develop a hybrid model, providing ad hoc advice with digital support, utilising your existing skill sets. When will you go live with this model, and how will you advertise it to potential investors?
Yeah. So early stage with that strategy, the first step was really implementing the premium platform within our advice model. So we announced last year a partnership with Premium, and that over the last 4 months, we have been working on implementing that solution to our traditional Bell Potter Securities advice business. All of the portfolios have now migrated onto the Premium platform. We're running in parallel, and we will go live in somewhere in the next 6 weeks. So we're looking forward to that. I think the implementation of that platform inside of our advice business means that we can be a lot more holistic around how we provide advice to our clients. The research we did, almost 2 years ago now, told us that our clients only hold 50% of their assets with us because they see us as an equities house. The implementation of the Premium platform will now allow us to address the other parts of their portfolios that we haven't been able to in the past with some scale. So that includes a whole managed fund universe, fixed income, property, and also now more the alts sector, like private credit and equity. The first part of that is implementing the Premium platform, and that will happen, as I said, in the next 6 weeks. Once that's in, then we'll start to develop some of the more hybrid approach to research, to advice. I expect that's going to take a little while. Most strategies are easy to say and harder to execute.
Yeah.
But the Premium platform is the kickoff that allows us then to start rolling those other pieces out to the wider population.
And your recent interest in self-wealth and your strong balance sheet suggests that M&A remains a focus. What types of businesses would complement your existing business?
So one of the things that we probably don't talk about enough is one of the key differentiators we have in our business is the fact that we own all our own technology. So we have an end-to-end broking system. which is unique to the Australian market. Most of the other brokers in the country will use third-party systems, and there's not actually one system that does all of it. So we have a system that obviously manages the front-end user experience and UI for the clients, a middle office where we know who the clients are, we know what stock they earn, we can identify them, we manage all our permissioning through that CRM system. And then there's the back-end connectivity to the ASX. So we have our own order engine. So we can operate a broker across all parts of that business without the use of any external technology. Now, obviously, we do interface and interact with other technologies where required by our clients. So a key component of an acquisition would be one that we could take and put on top of our system. So which is, we'll make it highly synergistic effectively by basically taking revenue and deploying that revenue across our existing infrastructure. So that's something that would make a lot of sense to us because it would be, as I said, highly synergistic and EPS accretive to the business. The other type of acquisition we look for is something that is adjacent. So as you just mentioned earlier, the creation of this hybrid advice approach, there are many parts and components of that we will look to either buy or build internally. And that's really about how we collapse the time frame as we develop and execute that strategy. So we're looking for those kinds of components as well. And that might include either advice groups that are already existing and operating in that model, and/or product that we might be able to deploy through that more broader end-to-end service proposition.
And 70% of the business is recurring in nature and growing. Can you take us through the growth opportunities in the businesses that comprise this, namely third-party clearing, margin lending, portfolio administration services, and technology?
Yes. So all of those businesses have got a very interesting growth trajectory. I'm just trying to pull up some numbers so I can talk to that in a little bit more detail. So just to give you some insight, our margin loan book increased to 603 million at the end of April. So that's up from, I think it was just 580, I think maybe at the end of the year. So it's lifted a little bit since the end of the year. Our cash book has grown quite strongly as well. It's now at 646 million at the end of April. So both of those items obviously are highly recurring revenue businesses. And where we can match the cash book to the margin lending book, obviously we maximize the margin. And we saw in 2025 where we were able to do that. And there was certainly a lift in the margin in our margin lending or our Bell Potter Capital business. There is certainly opportunity there as we've launched the Tandem brand late last year in that business. And the Tandem brand is created really to offer these services to other brokers, other financial advisors in the marketplace. We're starting to get some traction with some of our competitors, small, but certainly there's some traction there. And we think that's really the opportunity for growth. Because as you can imagine, we've that margin lending book and cash book is deployed and distributed through our Bell Potter Securities business, as well as our Bell Direct and Desktop Broker business. So there's a continuing distribution opportunity there. But in terms of breakthrough opportunity, it is these new client relationships that will make a difference. In the clearing business, we are always talking to new clearing clients. They are big and complex arrangements, so they take time, and those negotiations can take anywhere from 1 year to 3 years, and it's also dependent on when their existing agreements terminate or end. So there's always conversations there. If we are successful in getting one of them, the many that we are talking to at the moment, the upside is it's chunky in terms of revenue lift and margin lift. So that's the upside and the opportunity, but it's not linear in that context. They'll happen and they'll happen. We in most cases can't control the timing in those contexts, but rest assured we have many conversations going in that context. In the context of the Bell Direct and Desktop Broker businesses, I think that those two businesses just have underlying growth And we've seen, I think, CAGR revenue, I think is about 24%. I can't remember now.
Wow.
But so that business just continues to grow, and that's just generally normal BAU client acquisition and advisor acquisition, but strong growth trajectory in both those businesses.
Mhm. And portfolio administration services and technology.
Yeah, so the portfolio administration services is now what we call our private wealth service,
All
and
right.
and that's effectively the whole premium implementation
Okay.
and rollout. So I can tell you that the take up this year has accelerated from where we were last year,
Mhm.
and that's really on, I think, off the back of our advisors feeling a little bit more confident on our capability going forward. So we'll probably share a little bit more detail around that at the half once we're
Mhm.
fully up and live. But certainly the initial observation is that the advisors are more confident, so are actually talking a lot more to their clients around how to move from a traditional broking model to a private wealth model.
Well, thank you, Arnie Selvarajah, for joining me today. I'm looking forward to coming back to you in a few months' time to check on Bell Financial Group's progress.
Great. Thank you. Thanks for having me today.